Gold at $5,000, silver smashing past $100. You look at the charts and you think, this is a bubble. It's too late. But you are wrong. According to legendary analyst David Morgan, this isn't a bubble. The little guys, the retail investors, are actually selling. So, who is buying? The answer will scare you. It's not people. It's nations. It's China. It's India. They are draining the world's vaults to escape the US dollar. But be careful. Morgan warns that a violent crash is coming before the real moonshot. If you don't have an exit plan, you will lose everything. Welcome to the Bullion Ledger. Subscribe now and let's open the books. We need to talk about the numbers. They look impossible. Gold trading over $5,000. Silver surging past $100. In fact, on the day this report was recorded, silver hit an intraday high of $121. If you look at a chart, it looks like a rocket ship. It goes straight up. In financial terms, we call this a parabolic move. Usually, when you see a chart like this, you should run away. It usually means everyone is getting greedy. It usually means a crash is coming tomorrow. But David Morgan, the publisher of the Morgan Report, says this time is different. He sat down with Mike Mahari from Money Metals to analyze this insanity. Morgan admits the chart looks scary. He admits it looks like a bubble. But here's the twist. In a normal bubble, your neighbor, your taxi driver, and your barber are all buying. That is called retail euphoria. That is not happening right now. In fact, many regular people who own physical silver are selling it. They see the high price and they're cashing out. So, if the regular people are selling, who is buying? And why is the price still going up? Let's dig deeper into this selling mystery. David Morgan pointed out something very strange. As the price of silver climbed to $100, coin shops were flooded with sellers. Regular folks were dumping their silver coins to get cash. In a normal market, this selling pressure should push the price down, but the price kept going up. This implies one thing: the buyers are much, much bigger than the sellers. These aren't people buying a few ounces. These are strategic sources. We are talking about entities that buy in tons, not ounces. Morgan believes the strongest buying pressure is coming from the biggest players on the planet. Why does this matter to you? Because it means the floor of the market is strong. If the price was driven by regular people, they would panic and sell as soon as the price dropped. But strategic buyers like nations and massive industries don't panic. They accumulate. They are sucking up the supply while the retail investors are giving it away. Morgan warns that we are in a dangerous phase. You might be right about the direction of gold and silver. You know they are going up, but the volatility will be punishing. Imagine gold dropping $300 in a single day. Imagine silver falling from $120 down to $111 in a few hours. That happened. If you are trading with borrowed money or leverage, you get wiped out. Morgan says you can be right on the long-term trend, but still lose all your money because of these sudden drops. The market is going to try to shake you out. And the reason it is so volatile is because the entire global financial system is shifting. Why are these strategic buyers suddenly so hungry for gold and silver? David Morgan says you have to look at geopolitics. The world is scared. Trust in the global reserve assets, mostly the US dollar and US treasuries, is rotting away. Morgan pointed to one specific event that changed history: the freezing of Russian reserves. When the conflict in Ukraine escalated, the US and its allies froze roughly $300 billion of Russia's money. This sent a shockwave through the world. It told every other country a clear message: if you disagree with the United States, your money is not safe. Your savings can be turned off with a switch. Dollar-held reserves are now seen as politically constrained. So, what is the alternative? Gold. Gold is a neutral asset. It sits outside of anyone's control. You hold it, you own it. No one can freeze a bar of gold sitting in your own vault. This is why we are seeing a massive shift. Morgan used China as the prime example. China used to hold about $1 trillion in U.S. treasuries. That is a massive amount of American debt. Recently, they reduced that holding down to roughly $600 billion. That is a huge drop in a short period. Where did that money go? Morgan argues that a big chunk of that wealth flowed directly into gold. This is the strategic buying we talked about. This isn't about making a quick profit. This is about national security. This is about survival. And it is not just China. It is India. It is the BRICS nations. They are moving away from the dollar because they have to. This demand is intense. And it is very difficult to satisfy in real time. The mines cannot produce gold and silver fast enough to match this panic buying from world governments. Let's talk about silver specifically. Is there a shortage? David Morgan says, yes, it certainly appears that way, but it's a weird kind of shortage. If you live in North America, you might not see it. In the U.S., dealers are reporting that people are reluctant to buy silver. There are reports of wide buyback spreads. That means dealers are charging you a lot to buy but paying you less to sell. It looks like a loose market. But look at Asia. Morgan describes a massive pull for commercial bars. These are the 1,000-ounce bars, the big bricks used by industry and ETFs. India and China are vacuuming these bars up. Mike Mahari from Money Metals confirmed this. He noted that they have been shipping 1,000-ounce bars to India. The buying there is picking up after a long period of selling. This creates a disconnect. North America is out of sync with the rest of the world. While Americans are selling their silver eagles, Asians are buying industrial bars. This is dangerous for the American investor. You might look at your local shop and think, there is plenty of silver. No rush. But the global supply is being drained at the wholesale level. When the shortage hits the retail level, it will happen overnight. You will go to buy, and there will be nothing left. Or the price will be double what you expect. This demand is driven by a mix of investment fear and industrial need. Solar panels, electronics, batteries, they all need silver. And now, nations need it for their reserves too. It is a perfect storm for a supply squeeze. We mentioned the crash earlier. Let's look at the day silver hit $121. It didn't stay there. It pulled back sharply. Gold dropped more than $300. Silver slid toward $111. Why? If demand is so high, why did the price crash? David Morgan blames the machines. Algorithmic trading. In the modern world, much of the price action is driven by computers, not humans. These computers trade paper silver and paper gold, not the real metal. When the price moves too fast, the algorithms trigger a sell-off. It creates a snowball effect. Momentum breaks. The selling intensifies. Large players, the big banks, step in to manage their short exposure. They want the price down so they don't lose money on their bets. They try to trigger cascading stops. This means they push the price down just enough to force other traders to sell automatically. It is a game of dominoes. Morgan's point is crucial. The fundamentals are strong. The shortage is real, but the price behavior will look chaotic, especially late in a major move. Do not let the paper price fool you. Just because the screen says silver dropped $10, it doesn't mean the metal is less valuable. It just means the paper market is washing out the gamblers. Morgan warns that this speed and disorder will define the next phase, sharp sell-offs without notice, followed by equally abrupt recoveries. You need a stomach of steel to survive this. So, what happens next? Morgan believes we are in a new monetary era. He calls it the post-1971 break. Since 1971, the world has operated on a fiat standard. Faith in the dollar. That faith is now being tested. For decades, investors ignored gold and silver. Morgan says most portfolios hold less than 1% in precious metals. Many hold 0, but this is changing. Imagine if a typical 401k retirement account started to shift. Let's say a portfolio has $400,000. Usually it's 60% stocks, 40% bonds. What if they shifted just 20% into gold? That is $80,000 of new demand from just one person. Now multiply that by millions of retirees. If even a modest share of retirement capital treats gold and silver as true hedges, the demand will go off the charts. Incremental demand from the big money pools like pension funds and 401ks could keep prices high for a long time. We're talking about a shift from paper assets to hard assets, and there isn't enough gold and silver to go around if everyone tries to do this at once. Finally, we need a plan. You don't want to just hold until the market crashes again. You want to lock in your wealth. David Morgan shared his personal strategy for this environment. He uses the gold-silver ratio. This is simply the price of gold divided by the price of silver. During the interview, the ratio was around 46-1. This means 1 ounce of gold costs the same as 46 ounces of silver. Morgan suggests swapping your silver into gold as this ratio gets tighter. Why? Because gold is more stable. Silver is the race car. Gold is the tank. When silver shoots up, you trade it for the tank to protect your winnings. Here is Morgan's guideline. Start swapping around 50-1. Make additional swaps at 40-1, and then again at 30-1. He suggests swapping about 20% of your silver stack at that 30-1 level. If the market goes completely crazy extreme mania, the ratio could hit 20-1. That is your deep target. Morgan remembers 2011. The ratio hit 33 briefly. It happens fast. If you don't have these levels written down, you will miss it. You will get greedy. You will wait for it to go lower, and then it will snap back and you will lose your chance. He prefers predefined levels. Do not improvise during a spike. Understand the market you are in. Avoid decisions that only make sense in calm conditions. This is not a calm condition. This is a financial hurricane. The days of easy money are over. The warning from David Morgan is clear. The move to $5,000 gold and $100 silver is real, but the path there is going to be violent. The algorithms will try to shake you out. The volatility will test your nerve. But remember the fundamentals. The East is buying. The reserves are shifting. The shortage is real. Don't get distracted by the paper price. Watch the metal. This video is for informational purposes only and is not financial advice. Always consult with a professional before making investment decisions. If you want to stay ahead of the global reset, you are in the right place. Hit that subscribe button. Turn on notifications. This is the Bullion Ledger. We'll see you in the next one.